As harvest time nears in the Midwest, farmers are feeling a familiar squeeze from two fronts: a tightening market and unpredictable weather. The ongoing uncertainty around U.S. tariffs and sales to China is closing a critical trade window. At the same time, excessive rainfall and seasonal heat waves are disrupting crop yields. The outcome for farmers is clear: falling income expectations and rising costs for energy and inputs are putting immense pressure on cash flow. This isn't just a foreign trade issue, it's a broader economic one that ripples out to consumer pricing and rural employment here at home. The early signals from the field are significant. Some cooperative managers report they haven't seen a single new season order from China yet. This tells us two things: the price competitiveness of U.S. goods has weakened for Chinese buyers, and trade has temporarily shifted to South America due to the tariff burden. After duties, U.S. cargo can't offer a meaningful discount, while Brazil has locked down shipping flows for the season's critical months by pre-booking, securing port berths that would have gone to the U.S. If this continues, the traditional U.S. sales window of September to January will shrink. Even if an opportunity arises late in the year, the lost volume from earlier is often gone for good. Meanwhile, there's a simultaneous squeeze on the farm side. A cool, rainy start in Ohio and surrounding areas, followed by a sudden warm-up, has created a perfect environment for soybean diseases. In seasons like this, micro-decisions in the field become critical. If a spray window is missed due to rain, the yield loss is locked in until harvest. Seeing this risk, farmers adopt more cautious budgets, prioritizing maintenance and repairs over new equipment. And those imported spare parts and service items have only gotten more expensive under tariffs. In times like these, even a single rain event can disrupt transport and port planning. Delays at the dock directly impact shipping costs and the entire logistics chain from the field to the grain elevator. Here, the three main price-setting variables collide: access to foreign markets, weather, and financing. If export channels narrow due to tariffs, the domestic market demands discounts for excess supply. Weather reduces yields while also raising costs. Rain slows field work, driving up labor and diesel consumption and increasing wear and tear. On financing, if high interest rates persist, the business investment cycle stalls. Loan payments take priority, and government support becomes less effective. The result is a widespread wait-and-see behavior in rural areas, which reduces market trading volume and makes prices fragile. So why is Brazil at an advantage? The answer is logistics, seasonality, and contracts. Their southern hemisphere calendar is in sync with China's inventory needs. Combined with efficient ports and the ability to consistently secure shipping slots, this rhythm reduces the buyer's total cost. If U.S.-China tariffs are constantly in flux, buyers also factor in procedural risk and opt for a longer but more predictable trade corridor. This means trade flows aren't based on price alone; certainty has value. Therefore, 90-day extensions or last-minute announcements from the north only provide short-term relief. Supply chains won't make permanent decisions until the contract language is clear. At the credit and insurance table, the picture is straightforward. The farmer's main question is, will my cash flow be positive this season? While USDA projections point to lower prices for soybeans and corn, if the increase in volume isn't enough to offset the decline, cash flow tightens. The bank wants to see debt service secured within the budget. The machinery manufacturer prioritizes maintenance and repair contracts over new factory output. The dealer becomes more selective in stocking imported parts. The common denominator for everyone is the uncertainty premium, which grows when external variables like tariffs play a significant role. As this premium grows, even if consumer prices stay the same, the real cost for farmers increases through more expensive credit and longer waiting times. The debate over public support is often stuck between two extremes. One side argues large-scale budget support creates a long-term burden on the Treasury, while the other emphasizes that rural social risks can't be managed without it. A robust solution needs both, but the key is how the support is targeted. For example, opening temporary, scheduled exemption windows for specific agricultural machinery components directly reduces costs. Simplifying customs guidelines and speeding up duty appeals reduces port and shipping delays. Designing a special crop insurance index for weather-related cost overlaps aligns risk management with real-world conditions. These technical steps get little media attention, but their market impact is more lasting than grand statements. We should also discuss psychosocial risks in rural areas because the economy isn't just numbers. Prolonged uncertainty, 2 bad seasons in a row, and closed foreign markets can push family businesses to the brink. A transparent debt restructuring framework, accessible advisory services, and production planning support through local cooperatives can make a real difference for employment and well-being. The field isn't just a production area, it indirectly finances the village school, local services, and the regional hospital. Any tariff or weather event that breaks this chain also undermines public services. We can clearly outline the framework for the coming months. Unless China commits to a written schedule for import decisions, U.S. soybeans are unlikely to secure a meaningful share during the October-November peak. As South American cargo flows smoothly, the flexible window for U.S. shipping narrows, creating sustained discount pressure. At a certain point, the focus shifts from price to simple access. Weather optimism also requires caution. While late summer rains could help, excessive rainfall during harvest could reduce quality. Therefore, the producer's strongest tool is to diversify contracts and spread out sales terms. While selling everything at once might seem appealing, the greatest losses come from sales concentrated in a single delivery period. 3 actionable steps stand out on the policy side. First, the timely and transparent announcement of product-specific exemption windows between the U.S. and China. This provides clarity for trade. Second, reducing waiting times by implementing electronic queuing and joint control lists at ports and for transport. This leads to cost reductions for supply chains. Third, a tax incentive scheme for remanufacturing and repairing agricultural machinery parts. This allows for the rational financing of maintenance instead of new investment. If implemented together, these steps would ease pressure on consumer prices more quickly and help maintain rural employment stability. The question of what to do first remains, but a framework is clear. Instead of frequently changing tariff language, we need a clear guide with evaluation criteria, a seasonal exception table for exports, and clear customs coding to prevent misclassification from the start. This framework enables competition through clear procedures, not just aid. When the procedure is clear, the container moves to the dock. When the dock is efficient, the market calms down. And when the market is calm, the farmer can look forward to the new season with confidence. Let's be clear, the real agenda in the Midwest isn't just a slogan. It's the moisture in the field, the queue at the elevator, the crane at the dock, the shipping manifest, and the single-page contract signed at the bank. When these simple details are in balance, the noise of grand statements fades away on its own. We'll continue to update this analysis in the same straightforward language as new official texts and market signals emerge. In your opinion, which step would be most effective in the short term, announcing product-specific exceptions on a schedule, or implementing a procedure package to reduce waiting times at ports and in transport? Share your thoughts in the comments. Thank you for watching. Stay tuned for updates.